This is unwinding, and I think it's the start of the next leg. The next leg will not be comfortable. And that's when that spread relationship between gold and the S&P will really express itself even more so, with not only gold going up further, but the stock market actually coming down.
If we were to cover the outstanding debt with the gold that we say we have, you're talking close to $150,000 an ounce. That's where the price would have to go. But that's assuming we have 8,300 tons. And I personally assume that we do not have 8,300 tons and that gold has been going out the back door for years and years and years. 1956 was the last year there was an audit.
Michael Oliver observes that the global financial system is entering a highly volatile period, one that could push silver and gold to unprecedented levels. He points to historical episodes like the late 1970s, when precious metals soared despite widespread economic weakness. According to Oliver, these surges are driven less by short-term supply and demand and more by the flow of money across markets. Governments and central banks, focused on shoring up bond markets and stabilizing equities, are injecting liquidity at levels unseen in decades. This flood of capital often finds its way into tangible assets, particularly precious metals, creating conditions for sharp, sustained price movements. Recent monetary actions indicate that this trend is only strengthening, setting the stage for what could be one of the most significant silver breakouts in modern history. Oliver emphasizes the fragility of long-term government debt markets, especially U.S. Treasuries, where interventions have yet to fully calm investors. Despite attempts to suppress yields through purchases and other mechanisms, underlying structural weaknesses remain, leaving markets vulnerable to sudden shocks. Meanwhile, unconventional actors, including major digital asset firms, are increasingly acquiring physical gold, intensifying upward pressure on precious metals. Oliver notes that this mix of traditional and emerging demand, combined with rising inflationary pressures, is creating a rare alignment that favors tangible assets over paper-based investments. Looking into 2026, Oliver suggests that these trends are poised to continue reshaping investment behavior. The combination of central bank interventions, persistent market volatility, and concerns over sovereign debt stability is directing capital toward gold and silver as safe havens. Momentum indicators point to a breakout that could exceed historical norms, signaling a long-term rally in these metals. For investors seeking protection against instability and currency erosion, Oliver sees gold and silver as essential assets, capable of capturing value even amid turbulent economic conditions. Now, we present the clips from Michael Oliver's interview. Before we continue, please subscribe to our channel and activate the bell icon to receive timely updates. Thank you, and enjoy the video.
The dollar's anemic as hell. I mean, at price of 104.21 at the close of April this year. By the way, it was going down with the stock market at that point. The stock market since rebounded, but the dollar didn't. Okay, it went down under 100. Dollar index I'm talking about now, which is primarily the euro and the yen. They're 70% of the dollar index. It's now trading around 98. It's just lethargic down there. Can't seem to get a rally going. It's already broken its long-term momentum structure and it's going lower. Okay, but it's not really a good timing element for gold, especially. The correlation is not good. So if you look at it and say, well, if the dollar doesn't go down, which it's been stable for 6 months, you shouldn't buy gold. Well, gold's exploded since 2015. The dollar index has gone sideways, actually. In December of 2015, it was 97, 98. That's what we're trading right now, 10 years later. Yeah, gold is what? Fourfolded. Okay. Forget the dollar now. Let's go to the T-bonds. T-bond market, U.S. government long debt. And we can talk about the Japanese have the same problem. The UK has the same problem. Europe has the same problem. So it's not just us. T-bond market collapsed 2020 to 2022 in price, went up big in yield. The low of that monthly drop, that collapsed low in 2022, which is October. So it's been, what, 3 years? 3, 4, 5. Yeah, been three full years. It was 117. We're right now 115. Okay. It has tried during that 3-year period to have rallies in the T-bonds. Drops in yields, but they don't go anywhere and it relapses. Try it again. We've had 3 waves of upside effort in price, 3 attempts to break the yield down. They don't work. That concerns the Fed. And so Williams, the head of the New York Fed, a month or so ago said in a speech or a press conference, and no doubt he was permitted to say this, the Fed is going to start buying, quote, buying bonds. Okay. And he said the reason was, oh, no, not some trouble in the bond market, just illiquidity in the bond market. They want to provide liquidity. Okay. So if they've been buying, as we know they have, how come it's not going up? How come they can't get those yields down on the long end? They can cut short rates all they want, but it doesn't impact that long end. And that's a market that right now at 115, we're telling people technically you don't want to go back, you don't want to drop 4 points from here, down around 111, which approaches the lows we saw a year or so ago. Doesn't take them out, but you just approach those lows, you could implode the bond market in a downside route that would panic the Fed into going berserk, because that market is bigger than the US stock market. And if you cause doubt about whether you should buy T-bonds or Japanese bonds or UK bonds, and people don't trust their government debt instruments, what happens? This is unwinding, and I think it's the start of the next leg. The next leg will not be comfortable. And that's when that spread relationship between gold and the S&P will really express itself even more so, with not only gold going up further, but the stock market actually coming down. And that spread chart has a long way to go, and it is a fresh breakout of an 11-year wide base. You don't go up for a month or two and say, oh, that was it. You just broke out. That spread relationship is going to persist for a couple of years at least. And God knows where gold is going to be during that process. Both parties, I see a future, not just based on market movements, but fundamental underlying issues, government debt, political stability, things like that, where notions of normality will go out the window, not just market normalities, not just assumptions about is government debt even stable, but we have a two-party system for decades now. One takes power, they exist for another 8 years or so, but the policies really don't change that much. The debt grows and grows. May go to this component or that component, but it's still a rising debt situation. The Democrat Party we know is fractured badly. They don't know whether to go moderate or go radical left. And who knows, maybe they'll split and go both ways. The Republican Party is totally fractured now. The old Goldwaterites, the Reaganites, the conservative intellectual base of the GOP, they're gone. A lot of them are leaving the party. They're running for local office and abandoning their congressional seats. I've read this recently, that the number that are not running again and going to local or going to business or something, they're leaving. They don't like what's going on. They don't like what Trump's done in terms of global interventions and so forth, or in his desire to print money, which is hardly a conservative free market approach to an economy, printing money. That's what the left used to do. Now Trump wants to do it. So even the free marketers and the GOP are saying, hey, this isn't my party. So expect the GOP to fracture. Well, if both parties fracture, then neither party can get a majority. I mean, if you total sum popularity of the Democrat Party is 25 or 30%, and the same for the neither one is a majority, you'll suddenly have the rise of other maybe minority parties that might actually rival them in terms of gathering a percent of vote. Radical left, old GOP types, I don't know. But don't be surprised by that sort of fragmentation, which means this election coming up isn't just a shift back to the Democrats, because I don't think the Democrats quite know how to do that. Do we go left to get that vote? Do we go moderate, try to replicate some of Trump's things? They're split. So expect total chaos in that arena too. So anything you think is going to just shift to another norm again, it could be totally different than you expect. So get somewhere where you think it's safe.
That's
and
gold.
you know what that is, okay? We know what that is.
Recent trading activity is drawing renewed attention to the growing divide between gold and silver, particularly in the physical market. While gold is showing firm demand and mild regional premiums, especially in Asia, silver is experiencing far more intense pressure. The key difference lies in supply. Gold has been accumulated for thousands of years, and most of it still exists above ground in vaults, central bank reserves, or jewelry. Silver, on the other hand, is steadily consumed by industry, from solar panels and electronics to medical and defense applications, leaving little in the way of meaningful global stockpiles. This imbalance is now showing up in the form of elevated premiums for physical silver relative to futures pricing. Bill Holter argues that this tightening dynamic could carry broader consequences beyond metals alone. He points to rising demand for physical delivery, driven increasingly by institutions, family offices, and sovereign buyers, as a warning sign for paper-based markets. Silver's inelastic supply, largely tied to byproduct mining, makes it especially vulnerable to delivery stress, which could undermine confidence in futures markets if obligations cannot be met. Holter cautions that any breakdown in trust would not remain isolated to precious metals, but could spill into wider financial markets, where leverage and derivatives depend heavily on confidence and smooth settlement.
You're seeing it in a smaller way. The Shanghai premium is much smaller. Understand that gold has been mined for thousands of years, and pretty much all the gold that was mined is still above ground. It's either in storage form or it's jewelry. It doesn't get used like silver. Silver, when they pull an ounce of silver out of the ground, how many different uses are there for that? You've got solar, you've got medicinal, you have technological, you have jewelry, you have just investors buying it. The silver that has been produced over the last few thousand years largely has already been used. There's not any big stockpiles, whereas gold, there are some very, very large stockpiles, and I think larger stockpiles than are being let on. I think Russia and China both have well more gold than what they're letting on, and I think the U.S. has far less gold than we say. Gold is money. It's the only currency, gold and silver, the only currencies that you can trust. Everything else is freely printed. Everything else is fiat. So the shock waves will be one of trust, and the shock waves are not going to be held just to the precious metals markets. If silver fails to deliver, and I fully expect silver to fail to deliver in both New York and in London, but when it fails to deliver, that is going to affect all other derivatives because everything runs on trust, and it will probably create much, much higher interest rates in the U.S. because borrowing is done based on trust. And if trust is collapsing, then we'll finally have a risk premium for owning U.S. paper. I think you're seeing a lot of family offices do that. It's big money. For years we saw the retail market in the United States was a big buyer. The retail market is nothing now. The retail market is not even a tailwind. This is institutional money. I mean, these are hedge funds. These are private family offices. And in some cases, sovereigns. Look at Russia. They declared they declared silver a strategic metal, and they're buying it. Look at the imports into India. And those are official purchases. There's obviously reasons for buyers to lie. I bought more than I bought, or I bought less than I bought. It's hard to know, but the bottom line is we're seeing massive demand. We're watching inventories deplete, and at some point in time, there is a tipping point, and that tipping point will be a failure to deliver. It's a game changer, but how long can they do it? Where the supply is going to come from? The supply is not there. The way to fix this is to raise the price massively to entice some people that have bought to sell, because right now, anybody who bought physical metal has not been a seller. I guarantee you there was no big tranches of silver or gold that were sold yesterday. Physical metal. That was all paper. And actually, you can see it's all paper because the Federal Reserve lent, $17 billion on Thursday night, and then they lent another, 35 billion over the weekend. to the banking system. And where would the stress have been? It would have been in silver and gold. Look at the price of silver on Friday. It was up, what, $758, something like that. So those shorts had margin calls. The Fed helped them meet the margin calls and gave them enough to pile more paper on. The only problem is they can't print silver. They can't print contracts that have silver attached to them to deliver. They can sell contracts all they want and depress the paper price, but that is not going to satisfy silver, which is actually used. For a good part of the year, I took more sell orders this year, 2025, than I had cumulatively from 2010 to 2024. So there was a ton of selling. And I did query pretty much all of my people that were selling, and I asked them why. And the vast majority, probably 75, 80% of them said, I need the money. I need the money to live on. I got bills. I got this. I got that. You had some people wanting to buy real estate or buy other things. Now, what's happened in the last, call it 2, 3, 4 weeks, is that's turned. Retail is now buying. The one sector that is still under heavy pressure is junk silver. And the reason being, back in the 1970s and 1980s, the only way for an American to buy silver really was buying junk pre-1965 dimes, quarters, and half dollars. Now, those people sat on losses for 40, 50 years, and a lot of that metal has come back. I mean, there's a ton of sellers, and what's happened is dealers, because they were getting flooded with metal, they backed away price-wise, and as they backed away and made the discount larger and larger, then that metal was going to refineries to be refined into 99.9 silver, and they pocket the profit. But that's the pressure in the retail market, is selling of junk silver, which is a great opportunity if you're looking to buy silver. Junk silver is now the cheapest form that you can buy, and hands down, it is the best form for an American to own. It's the smallest denomination, which will be best for barter. It can't be counterfeited because they can't be shiny coins. These are in people's pockets. They've got to be scruffy. It's U.S. Mint lineage coin, so it's something that came from the U.S. Mint. Let's see, we have smallest denomination, U.S. Mint lineage. And it's totally readily recognizable. I mean, if you try to barter with say a 1 ounce buffalo or a bar or something like that, there's always going to be a question, is that real? But if you got a 1964 or earlier dime, quarter, half dollar, Americans know what they look like. And if the date is 64 or earlier, you know for a fact, that's proof, it's authentication, that it's 90% silver.
The next phase for gold and silver is likely to be shaped by tightening financial conditions, rising geopolitical strain, and growing distrust in paper-based promises. As debt levels expand and confidence in currency stability erodes, demand for tangible stores of value may continue to strengthen beneath the surface. Gold could increasingly be treated less as a trading vehicle and more as a strategic reserve asset, with steady accumulation absorbing supply during periods of price weakness. Silver, with its dual role as both a monetary metal and an essential industrial input, may experience sharper swings, but those swings could mask a broader trend of tightening availability and stronger long-term demand. Over time, repeated bouts of volatility may act as a cleansing mechanism, pushing speculative capital out while transferring ownership to longer-term holders focused on preservation rather than quick gains. If industrial consumption accelerates alongside renewed monetary demand, both metals could enter a phase where price discovery becomes more aggressive and less controllable by short-term market forces. In that environment, sudden upward repricing would not be driven by excitement, but by necessity as supply struggles to meet sustained demand, raising a critical question. When confidence finally breaks, will prices adjust gradually, or will they be forced to leap to entirely new levels almost overnight? Share your thoughts in the comments section below. If you found this insight useful, make sure to like, share, and spread this update to others watching the silver story unfold. Your support helps keep these deep dive analyses coming.